Think Realty Nation, it's your host, Abhi Golhar. Welcome to the Think Realty podcast. And the show today, we're talking about lending. We're talking about what it means to have things change on you kind of midstream and what's happening with the lending space. So if you're a borrower and you're like, well, what programs are available through Lending Home right now, and what kind of is the lay of the land given what's happening with COVID-19, when things should open back up, what I should be expecting right now, this show is for you. My guest today is Ray Williamson, who is the Director of Strategic Partnerships. He has an awesome title. Essentially, it makes him look super, super cool, which he already is, and I can't wait to have that interview with him and kind of understand the lay of the land, because for me, I'm a real estate investor. I love buying real estate, buy and hold real estate in different Midwest markets. So this is going to be an awesome conversation to kind of learn where Lending Home is with everything and, quite frankly, what's going to happen. He's the guy with the crystal ball, and I try to make my snow globe look like a crystal ball, and that never happens. So we'll get it directly from the horse's mouth coming up in just a second. This podcast is brought to you by Norada Real Estate Investments, your premier source for cash flow investment property. Check them out. Visit www.turnkeyrealestateinvestments.com. So, Ray, welcome to the show, man.
Thank you for having me, Abhi. I appreciate it.
You got it. So, you just told me, Director of Strategic Partnerships, Alliances, something that's super, super cool. So give us a little background on who you are and what you do with Lending Home.
So a little bit of background. I've been at Lending Home a little over 5 years, been in the mortgage business since 1989. I spent the first 3 years at Lending Home running all of operations. So it gave me some perspective as it relates to what customers experience and feel as they're transitioning loans through our system, and then obviously helped build out that platform, technology, et cetera, and then transitioned over to the sales side and work mostly with our experienced borrower channel, folks that are doing this vocationally, probably doing 3 or 4 projects a year plus, and trying to identify those folks and educate them on what we have provided other operators, what has been why experienced operators tend to choose a Lending Home over maybe another investment company. And so that's been great, kind of traveling around, getting in front of folks and finding out where their pain points might be, whether it's today or down the road. So somebody that's doing 4 projects a year, they kind of want to understand the pain points of somebody doing 10 to 15, right? So being able to share that regionally has been important. And has enabled us to, I think, accelerate our growth and theirs.
Awesome. So pre-COVID, right, we had all these, it was like, I remember I was doing interviews in February, and there was no recession in sight. It was clear skies, right? Not a problem. It was fantastic conversation, great. And now the story and the dialogue has changed. And overnight, all the lenders that I know, I mean, you know what happened. So what happened?
It was abrupt. I've been in the business for a long period of time. There's been very few times where something so abrupt has taken place, where there was almost no portfolio coverage for borrowers, right? They were just midstream, and all of a sudden it slammed down on them. And so I think certainly, the COVID virus has most, if not everything, to do with it. It created such a deep level of uncertainty for Wall Street investors that buy really good credit, well-performing loans. The uncertainty actually was greater than the sort of the promise of delivery, if you will. And so instead of having this hopefulness that things would figure itself out, those lenders that were delivering both rental loans to Wall Street and fix and flip loans to Wall Street, that delivery mechanism stopped immediately. So the only lenders really that were still able to provide financing on the fix and flip were those that either had a structured securitization, kind of fixed rate line of credit, if you will, or had sort of non-US bank funds that they didn't have to have a U.S. company essentially approving purchases of that business, or they just had enough self-endowed money, private money, et cetera, that allowed them to continue to lend. But most lenders that I'm familiar with had to make fairly immediate changes as it relates to preservation of capital, because we just didn't know how long this environment was going to last. And you certainly didn't know how borrowers would continue to perform, both on a monthly payment standpoint and then a daily payoff standpoint.
So, needless to say, it was a very, very serious situation.
It was. I mean, for lenders to stop lending overnight, right? Instead of just peeling back, I think that should emphasize how significant the event was and is, right? And so I think what has taken place is the further distance we've had from that, March weekend has enabled, I think, the space to have a little bit less degree of uncertainty, greater degree of more certainty that improvement is taking place, but not to the point where everything is reopened and going sort of back to normal. I would say, that Friday before the Monday, we're not heading to that normal anymore, right? So the cost of capital is going to be different and higher. The credit boxes may look different from either every or some lenders pre-COVID, right? Because the expectation that the capital markets will have from those lenders is, what changes are you making to enable the loans that are being purchased and transacted on sort of fit the new quality, right? And take into consideration this type of element, if you will.
So, so what is their expectation? What is Wall Street's expectation?
I think with anybody that's buying investments, right, whether they're backed by an asset like real estate or others, they're looking for consistency and certainty. What you don't want to do is, if you're an operator and we tell you that our creddet box is X and this is going to allow us to deliver this to you, and then we go breach that with other people, that causes an increase in delinquencies and then a need to adjust cost up across the board, then we've sort of breached that covenant with our borrowers, right? So I would say that when it's appropriate, an operator might be able to, get a cost structure that's appropriate for them based on their model and other factors. So from a lending standpoint on the fix and flip, we've adjusted leverage down for the most part. We're at 80% of cost. We finance 100% of rehab. And then there's a couple of nuances and process flow differences that are involved with whether or not somebody's an experienced operator, 5+ completed flips over the last 24 months or less than that. But we consider that to be that's what our terms are. We don't feel that we're going to have to adjust those down, meaning worse, going into the end of May, June, July, August. We feel that we have the capital infrastructure to continue to lend through this environment until we can start or reconcile negotiations that we currently are under with new and better financing partners, et cetera.
Yes.
On the rental side of things, that market is paused. Unless you can go directly to a bank or direct to a direct lender, and qualify under income documentations, ability to repay, debt to income ratio, kind of your loan depots, Quickens, et cetera, that market is stalled.
Got it.
And you can call it non-QM, or basically it was a FICO and equity driven product. That market completely froze beginning of April across the board, every lender that was offering that program. We feel that it will thaw a bit sometime in June. We're hopeful. We're certainly on the negotiations with folks that have bought our product before and others that may continue to buy it in the future.
Yeah.
And then what coupon we would need to offer so that that is market acceptable.
Mm-hmm.
And then are there some credit box nuances that we have to have as, I'll use the mortgage term, overlay into it, whether it's initially or permanently, so that that product can actually be, purchased and kind of woven into securitizations like it has been.
So from a certainty, so going back to consistency and certainty, we talked about consistency. So what it looks like is in mid-June, we're kind of start thawing a little bit. Why mid-June? Is that because we now have a little more data than we did in Friday, the 13th of March, which is just a weird, ominous day anyway? And is that like we should start seeing some plateauing of this entire COVID number, that situation, and will that bring back some level of certainty to Wall Street to say, if this happens, then certainty, and if certainty, then here are the necessary dynamics of the box that we're looking at?
I think that's put pretty well. That's exactly what's taking place. So as you can imagine, every lender that was packaging these rental loans up for purchase to these Wall Street companies have been in constant dialogue with those companies since the program paused.
Yeah.
And to identify what needs to happen for it to unpause, there's a couple of things, and you sort of have to bifurcate what the product looks like with the market acceptance of actually buying it in the first place.
Yeah.
Right. And so probably the biggest lever on that is unemployment.
Yes.
So when you look at it, the folks that have been unfortunately, displaced and affected from an employment standpoint, whether it's, and hopefully temporary, those were going to be the renters paying rent on these investment properties. And these Wall Street companies saw that, wow, we have a product out there that really does not involve, a deep dive into income, really doesn't involve a deep dive into cash flow analysis or even reserve analysis. And, the DSCR, the debt service requirement, is, above 1.2. But what happens if we don't know if an operator can withstand a month, 3 months, 6 months of not receiving rent?
Right.
So that was so uncertain. You couldn't even price that appropriately. And
I get that, right? Doug Duncan, and I just saw this the other day, Doug Duncan, who's the chief economist at Fannie Mae, said, listen, in 2018, at the peak of 2008, you have 15.3 million jobless claims. Where are we today? We're far past that number.
Yeah, we're 2.5x that.
So he also then said two very interesting things. Number one, he said, when the economies flip back on, and whenever that happens, it's going to take 3 to 6 months for the unemployment numbers to get to the 2008 level, which is where they'll probably stay for a little bit of time. That means that we'll still be at 15 million unemployed, roughly, and that any economic gains that have been made since 2008 will be completely wiped out. So for the viewer that's listening to this, that might be a little confused, but I think we're being very clear here. That's the uncertainty that Ray is talking about. And that is a very big uncertainty. I would have a problem with that. So what does it look like on the broker side? Because as a broker, as somebody that's, say, sending lending home deals on a regular basis, if I'm part of that group, and I'm sure there are many of them listening and watching this, what does that mean for me? Does that mean that I should still be in the conversation with lending home? Obviously, that's the case, but how do I process these things? How do I process these loans? How do I keep pushing them through? Do I continue my marketing efforts because that's money to be spent? Do I be cash heavy? Like, should I be cash heavy right now? Help me, you know what? Help me to the finish line. Give me some beacon of hope, right? Give me something, you know.
Hey, and you bring up a lot of good points, and one of them that I hope is not lost on your many, many listeners is when the new normal is, because we're in this interim period, right? So the new normal is, loans are being purchased. Yeah. It's not like, let's call it to make it simple, right? On a Friday, the interim period ends, and on this one Monday, June, July, August, whenever it's going to be, it's not like it's like this collective breath and like, great, now we're all back to what we were used to. That's not going to happen. The downside in this interim period is we don't know what that's going to look like yet, right? From a cost structure standpoint, et cetera. So the new normal is a long way away. Kind of to paraphrase what you were saying from the economist from Fannie Mae. I totally agree with that. And I'm certainly not going to try to trump somebody whose educational background in business is doing that. But what it means for brokers is, sometimes brokers, they didn't necessarily need to know how the sausage was made, right? How does this particular lender partner of mine deliver their loans on the secondary market?
Yes.
Right. So if you send loans in consistently and month after month, they act and do the same thing, asking how it's delivered becomes irrelevant.
Right.
Right. Then all of a sudden it was. And so how a lender is structured and will continue to be structured, both procedurally, right, how I'm doing in an interacting business, and then on the secondary market side is now all of a sudden the light's being shined on that. And I think it's important, I think from a diversification, I think is always important. We know that we're not going to win the 100% of the wallet share from every single borrower we work with, right? There's going to be a scenario where they're going out of state, or a loan amount's too low, or a property type is just outside of our sweet spot, or they have to close faster than we can humanly possibly do that. And so aligning yourself with different funding sources is always good from a business model standpoint. And just to kind of test the waters. Am I truly getting the process flow and all these things that is the best, right, in the market? And so what we are seeing from a broker standpoint is how we're structured. We're getting significant uptick in business because a lot of our broker competitor lenders, those were the ones, unfortunately, that had to temporarily stop lending. It will be a good day when everybody is back lending. I think borrowers benefit from that competition, right? Because then you have to look at 15 different people in your space as opposed to 3, and it really helps sharpen the saw, if you will, right, from Stephen Covey. And so in both on the cost standpoint, process flow standpoint, product standpoint, et cetera. So, thankfully we were set up appropriately to take on that additional business. And certainly there were some nuances that other lenders had that maybe we lacked initially, but having a live product that can be acted upon on behalf of their customers. And we take that seriously. I mean, a broker is presenting themselves as the source of money. And we do not want to do anything to disrupt that. Right? The customer has that trust with the broker, and we are not going to do anything, whether it's during the process or post-process, to disrupt that relationship, because we want to continue to get business back from those excellent sources of business.
Got it. So the lesson here for brokers: stay in the conversation and do what you can, preserve a little bit of cash, maybe work on your systems and processes during this time, and stay in tune with the market, keep your ear to the ground. And when we reach that new normal, don't expect that new normal to be the same as it was in February, and don't start complaining about that already. But stay in the conversation, and I think that's the most important part. Ray, thank you so much. This has been very informative. And we'll love to have you back. We'll make that happen soon.
Thanks for making time for me. I appreciate it.
You got it. Ray. Think Realty Nation, this next segment is brought to you by Clint Coons of Anderson Business Advisors. He's nationally recognized for providing bulletproof asset protection, tax, business, strategy advice to real estate investors. Go to getbulletprooftoday.com. Again, that's getbulletprooftoday.com and receive Clint's book, Asset Protection for Real Estate Investors, for free while supplies lasts. So, steps to closing. It's a little bit of a challenging time right now. I'm going to breeze through these, but these are really, really, really important. Okay, especially right now, and you can expect delays, right? You can also expect unexpected problems with the home. The inspector is going to come in and say, oh, well, that foundation looks kind of suspect, right? So that's a little bit of a problem. You want to expect these kind of problems, especially if you're buying older homes. There are going to be challenges with the HVAC, the roof, etc. So, one, build that into your budget, and number two, don't be surprised when the inspector says that, because you're kind of buying as is anyway, right? There's no warranty when you're buying from a homeowner that's owned this property for the last 25 or 30 years. So keep that in mind. This was a blog written on thinkrealty.com titled Steps to Closing You Need to Know, and it's also by Clever Investor. So definitely read it. Certainly important here. The other challenge here, as we just heard from Ray from Lending Home, there are going to be some financing issues and some delays, right? So here's the thing. If you're an investor, build that into your timeline. What normally took 7 days might take 15 or 20. And that's okay, because that's where we are right now. We're in this kind of interim financing time. It's going to take a second. So you as a borrower, get stronger. Hold some more cash so you can prove to a lender like Lending Home that you have the ability to put down money, you have the credibility, you have the experience, because that new box, that new lending box, it's going to be a lot more crucial to figure out what that is and fit into that long term. That's what's happening right now. So the steps to closing, a couple more title issues. We'll always run into title issues, but work with your title company or your closing agent, your real estate attorney, to work through those. But it's okay. Those things happen, not a big deal, unless it's a big deal that your title company, your real estate attorney will tell you. But outside of that, be open, be willing to work through challenges, and you'll be A-okay. That's the show today. If you have any questions, you know how to get in touch as well. This podcast was brought to you by, I'll tell you who exactly is brought to you by as soon as I move my notes back and forth. This podcast was brought to you by Norada Real Estate Investments, your premier source for cash flow investment property. Visit them at www.turnkeyrealestateinvestments.com. Think Realty Nation, it's been fun. Remember, keep your due diligence checklist close to your chest. Make sure that you do all your homework. If you're a broker, it's okay. We're going to get there. We're all in this together. And I'm going to make sure that you have the latest and greatest information you need from the experts to tell you exactly what to do and how to do it. So we're here for you. Anyway, get in touch. You know how to do it. thinkrealty.com/podcast. You can find me anywhere online at Abby Golhar. Stay cool, stay awesome, and until next time, happy investing.